Rumble stock, what's it worth, and where's it headed from here. We're going to start off with some of the fundamentals, and then we're going to do a valuation to see what's priced in and where it could be headed in the near future. So looking at it, we have a price per share of $6.71. We see that it operates at a loss for price to earnings. It has a market cap of 1.83 billion and an enterprise value of 1.59 billion. There's a cash debt ratio of 84.19, which means that for every dollar of debt, they have $84.19 to pay down their debts or expand their business. When it comes to their profitability, we see a whole lot of red, so not a great signal there, and it does look like the margins are decreasing. So definitely not an optimal sign. Versus history, these are the lowest gross margins they've had in the last 10 years, the lowest operating margin in the last 10 years, the lowest net margins in the last 10 years, lowest free cash flow in the last 10 years. So I use these to tell me about the business and how the business's profitability is. But for management strength, I use ROE, ROA, ROIC, and ROC. And for those as well, I see still in the negative. So the profitability is a very bad situation right now. Looking at their financials on a trailing 12-month basis, we can see that their revenue was increasing pretty significantly and then slowed and now is about the same as it was last quarter. Although we see that the net income is accelerating in a negative rate, so not exactly what you want to see. Cash to debt pile is fairly significant. They have currently 219 million in cash and 3 million in debts. So a good ratio for cash to debt. We see significant share sales, so decreasing shareholder value through increasing share count. So large share sales in 2022 and some small share sales recently, probably to raise funds or increase that cash pile. So maybe that's what happened here. Looking at their operating revenue by business segment, we see that 74% comes from advertising and 25.9% comes from licensing and others. Using the app, I've never seen an advertisement on the app, so I'm surprised that they have 74% of their advertising money. They currently operate in the United States mostly at just about 92% of their operating revenue. Canada with 1.3% and other countries at 6.8%. But to see what's currently priced in, let's run a DCF. Before we do that, if you do enjoy these type of videos and you enjoy my valuations, it really helps out if you leave a like and subscribe to the channel. I will be posting some cheap videos in the future of some undervalued businesses, and you're just going to have to stick around for that. So inside the DCF, we see zero business predictability, probably due to it being fairly new to the market and also having no data for the 10, 5-year average on free cash flow or earnings per share, and some negative numbers here. So let's see what's currently priced in for earnings per share. So looking at free cash flow, they currently have negative 0.55, so losing 55 cents per share. If I take away that negative and make it a positive, so they would have been earning 55 cents per share, growing at 6% a year, then there's a current fair value of roughly what it is today. That's a huge margin increase of what they are doing. So both for free cash flow and earnings per share, it's very hard to value this company, at least on a discount cash flow. It looks sort of like a gamble to me at this point because the cash flows and the earnings per share are so far off from being valuable. Again, they're losing 55 cents per share currently for free cash flow and 58 cents loss for earnings per share. So yeah, if you're interested in buying this company, it's more of just a gamble that in the future they will take some of that market share from YouTube, for example, or other streaming services. I do enjoy the business, but it looks like, at least for right now, there's nothing that shows me that this is going to be a long-term investing type thing. There's no level that this has to stop at. It could go way lower, it can go way higher. It all depends on sentiment. And I relate this almost like a meme coin at this point, where if people want to buy it, they can easily double the price. If they decide that it's not worth gambling on, then it could easily cut in half from here or even worse. So there's just not enough information, and looking at the cash flows and earnings and the margins, even though it does have a significant amount of cash in relation to their debts, it just doesn't look like something I'd want to gamble on. Again, I do enjoy the business. I like Rumble. I like going on the platform, and it makes me raise the question of why have I never seen an ad on the platform? If that's how they make their revenue, I've never seen an ad, and I've been using the platform for 6 months or longer. So it's a tough bet if you want to make that bet. But for me, it just doesn't look appropriate to buy this right now, because in investing, I really want to protect myself from that downside risk. And there's no protection, it looks like, from that downside risk. It's a tough investment for me, but if you do want to, just know that it's like buying a meme coin. You're betting that people are going to buy it and not care about the fundamentals, sort of gambling on in the next 5 years that they could take some market share, become more profitable, seriously increase those margins. As of right now, that just doesn't look like the case to me. But that being said, this is my analysis for Rumble stock, ticker symbol RUM. If you think differently about it, if you see something that I didn't see, or if you don't like this video, leave a comment. Let me know what you guys think. Leave a like. Make sure to subscribe, because I will be posting more businesses like this. And I'll see you next time.